Good morning, viewers. It's Thursday morning, May 22, 2025, and I'm your host, Sunil Thakker, or Sunny Talks Money. Welcome to ST Money 7 a.m. early morning news, where we provide you the latest, concise, and precise stock market wrap, accurate figures and numbers. Please mention your email in the comment section so that we can forward you the daily market wrap in your inbox at exactly 7 a.m. Eastern Time each weekday. Stocks fell sharply on Wednesday after a disappointing Treasury bond auction accelerated a sell off in the debt market. US stocks tumbled on Wednesday as bond yields continued to climb, putting pressure on equities as Wall Street fretted about the ballooning US debt, while Republican leaders aim to ready President Trump's tax bill for a House vote. The Dow Jones Industrial Average fell more than 1.9% or 817 points, leading indexes lower. The S&P 500 slid about 1.6% and the tech-heavy Nasdaq Composite fell about 1.4%. All three major Wall Street indexes closed with the biggest daily losses in a month. Small cap stocks also fell sharply, with the Russell 2000 index posting its biggest daily loss since April 10. All the three major indexes moved lower after a 1 p.m. 20-year bond auction saw weak demand and Treasury yields surged. Longer-term U.S. Treasury yields rose again, with the 10-year yield approaching 4.6% and the 30-year rate surging above 5%. It was the highest yield in the 10 years since February and the highest in the 30-year bond since October 2023. Yields extended gains in the afternoon after a $16 billion auction of 20-year Treasury bonds attracted relatively soft demand from investors selling at a higher yield than traders had anticipated. Meanwhile, traders are monitoring the tax and spending bill in Washington. President Trump has ratcheted up pressure on his party to pass legislation which contains an extension of tax cuts and adds new ones. A congressional committee set an unusual hearing as House Republicans sought to overcome internal divisions about proposed budget cuts, including the Medicaid health program. Nonpartisan analysts said the Republican bill could add between $3 trillion to $5 trillion over the next decade to the federal government's already $36.2 trillion debt. Investor anxieties about the bill, combined with Moody's rating stripping the US of its AAA credit rating late last week, have pushed Treasury yields higher in recent days. 10 of the 11 S&P 500 sectors fell, led by real estate, healthcare, financials, utilities, consumer discretionary, and technology equities. Communication services stocks gained. The sell-off in stocks followed earnings report from retailers Target, Lowe's, and TJX. Target cut its annual outlook, flagging softer discretionary spending and a decline in consumer confidence, while Lowe's held its guidance unchanged. TJX also maintained its outlooks, assuming current US China tariffs levels hold. Shares in all three fell. Walmart warned recently that levies would force it to hike prices, while Home Depot said its plan to hold the line. On Wednesday, Target said it aims to keep the price rise as small as possible. Google parent Alphabet rose 2.7%, while Nvidia lost 1.9%, Apple fell 2.3%, and Tesla shed 2.7%. Wolfspeed plunged nearly 60% after a report that the semiconductor supplier was preparing to file for bankruptcy within weeks. Also, the Dow's Industrials decline was exacerbated by 5.8% sell-off in United Health shares. United Health Group dropped nearly 6% after a Guardian report that the healthcare conglomerate secretly paid nursing homes thousands of dollars in bonuses to help reduce hospital transfers for ailing residents. HSBC downgraded the stock to reduce from hold. Morgan Stanley upgraded its stance on U.S. equities to overweight, saying the global economy was still expanding, albeit slowly amid policy uncertainty. Meanwhile, Bitcoin rallied to a fresh record of over $109,000 earlier in the session before reversing with the broader market. Bitcoin climbed to a new all-time high for the first time since January. The dollar index weakened on pace for the third day of declines. My take: when the auction fails, so does the market. Hello, and welcome to another episode of My Take. A weak treasury auction doesn't usually make headlines, but when it does, markets notice. And yesterday they did, big time. Yields jumped, stocks dropped, and risk sentiment soared quickly. Why? Because a poor auction tells us two things: demand for government debt is waning, and the cost of financing America's deficits just got more expansive. The tepid demand for a $16 billion sale of 20-year bonds has the US Treasury Department in jitters. Let's break that down. The US government relies on steady, strong demand to fund its borrowing needs. When a treasury auction is undersubscribed or needs higher yields to attract buyers, it's a red flag. It suggests investors are demanding more compensation to take on what's supposed to be risk free debt. That has a domino effect. Higher yields tighten financial conditions that pressures equity valuations. It weighs on corporate borrowing and it challenges the soft landing narrative markets have been clinging onto for months. But here's the real worry. If investors start losing faith in US fiscal discipline, auctions like this one won't be a one off. They will become the norm. And that could reset the entire pricing mechanism across markets. So, my take: watch treasury auctions closely. They are not just bond market events anymore, they are market moving signals about trust, credit, and what it really costs to run trillion-dollar deficits in post-pandemic world. The auction failed, but let's not fail to see the message it sends. I am Sunil Thakker of Sunny Talks Money, and that's my take. And that's a wrap for today, my dear viewers. And if you got value from this, please do subscribe, like, and share this video as much as possible. I will see you again tomorrow morning. In the meantime, happy investing, stay inspired, and remember, it is all about money.